Is now a good time to invest in the stock market? In fact, you may be wondering if it is a good time not only to buy stocks, but perhaps buy a house and invest in real estate. Or you may be thinking whether now is a good time to buy gold or silver as a safe haven. Maybe now is actually a good time to buy Bitcoin, considering the market is crashing and crypto is following that downtrend as well. I know a lot of you have those questions in your mind, and I want to address them in this video and ultimately answer the question, to buy or not to buy? That is the question. Or simply wait for the real bottom and capitalize on the market crash. So in this episode, I want to first start off with the big picture so we're all on the same page. Then I'll go over some of the suggestions from Forbes, which is the article that you see on the screen now, and I'll augment those with my suggestions. By the end of the video, we should all be comfortable answering for ourselves, is now a good time to invest in stocks, in real estate, crypto, gold, what have you. Let's look at the big picture here. What do we got? We've got a global pandemic. The stock market is crashing in 2020. S&P 500, for example, is really doing poorly. I mean, it's down 30% from its all-time highs. And this is to put it into context. If we look at the S&P 500 index for the last 10 or so years, we'll see that these 30% that it has dropped its value, it's basically putting us at the price for the S&P 500, which we had back in 2017. So we've lost about 3 years of gains. It's alarming that we're in bear market now. And compared to 2008, 2009, we've still made quite some money being invested in the S&P 500. Now, but what is triggering the market crash? You know, it's not only the pandemic, but also we have to be careful because there's also oil, which saw one of its biggest drops in history. It's down more than 30%. We've got huge oil supplies and very low demand. And this really triggers the low cost per barrel. And when we have that situation, it's imminent. We've got sort of the perfect storm where we've got the pandemic, we've got the oil prices crashing, we've got all this chaos that, governments are trying to deal with the situation. For example, the Fed is lowering rates on pressure from Trump. Then also Trump just signed a $2 trillion relief bill to help the smaller business to survive. And that's understandable. That's actually good measure, but how much it's going to help, we don't know. I think it's going to address the small business challenges for a few months, but for how long, it's really hard to say. And this is, by the way, what various governments across the world are doing the same thing. Every country is trying to stimulate its small business with various packages. Also coupled with the fact that we got the unemployment numbers last Friday, we've got about 3.3 million jobless claims, which I believe is about to increase. When we get the firm numbers, we may be looking at something around 4 or 5 million jobless claims. And that is a bad situation, guys, because that is only the beginning of when companies are starting to lay people off because they can't manage the hard times. And this is why it's really important for us to be grounded and really understand the fact that we are probably going into a recession. As a matter of fact, the IMF chief already said that the world is already in a recession. And this is really the picture, guys. It does not take a rocket scientist to recognize things are bad. However, I believe some of the politicians in certain roles, they're trying to sugarcoat things and trying to minimize the panic. On the one hand, I do expect that from them. This is true on a global level as well. All the country leaders, they tend to paint a nicer, more optimistic picture than what is happening. And be that as it may, I want to give you that painfully honest truth that companies will experience hardship. For several months, if not longer, a recession is imminent. Alright, so here's how you know if it's a good time to invest. I came across this article on Forbes and I thought it had very good advice. Particularly, the author stresses two very important points. So number one, do you have extra cash? And that's really, really important to be honest with yourself. Extra cash is indeed money that you have extra set aside. It's not the money that you borrowed from a friend. It's not the money that is part of your emergency fund. It's indeed extra money laying around. And that money, what's also important is that you don't need that money for the next several years. What I like to say is the money to invest in the stock market is money that you don't need in the next 5 years. And this is what the author of the article also stresses. Yes, years. Because there is so much volatility in the stock market, regardless if it's a bear market or bull market, there's so much volatility. And if you're gonna need that money, for example, as a down payment to buy a house, you don't want it in the stock market. You want to put it in a money market fund or some sort of a ladder CD, what have you. Even though you're going to be losing a little bit due to inflation, it's better to have that money sitting in cash so you're able to mobilize this when you're ready to buy a home. And if you think about this extra money or emergency fund that you may have now, think about it this way. Because of the uncertainty, because of the severity of the outbreak, maybe you should consider doubling down and increasing that emergency fund. What I like to say is everybody should have 3 to 6 months worth of expenses so they can weather kind of unforeseen circumstances. But because the situation is probably going to get significantly worse, you may consider bumping that up to about 9 months to a year worth of expenses. I think it's better to be prepared rather than being scared or acting irrational to putting your money in the market where you can actually make a bigger emergency fund for yourself so you can sleep at night. And the second point that I really want to highlight from this article, if we've established that you have this extra cash laying around for investing, is that if you've got the money to invest, stop looking for smoke signals. In other words, stop looking for the market bottom or stop trying to anticipate or predict when it's going to be the rock bottom so you go in at that point. Because the reality is nobody knows when it's going to be the bottom and nobody knows when it's going to be the recovery. As a matter of fact, the only way to know when there's going to be a recovery, when the recovery begins, is after the fact, after it happens. And I want to highlight here a paragraph which I thought it's absolutely important to digest. Your personal circumstances dictate when it's a good time to invest, not the current conditions in the financial markets. In fact, even if you bought at some of the pre-financial crisis highs, say you bought in January when the market was all-time high, you'd be better off staying invested than if you sold before the bottom and got back in during the recovery. Now think about that for a second. I think it's really difficult for some investors to really understand, but this is rooted in statistics and a lot of research. There's tons of studies done that it's hard to time the market and you're better off staying invested, staying the course, as I like to say. And also, I've highlighted before in other videos that time in the market is more important and it will give you higher return than timing the market. There's also another article that I want to highlight to you from Morningstar, and it's titled Why You Can't Time the Market. I think it's also a very, very important article, fairly recent, by the way, from this last Friday. And I think it's really important to look at this objective advice from Morningstar because it hits really important points, again, rooted at research that's been done by PhDs and professors at universities, people who have dedicated their entire life in studying the market and the fluctuations. And by the way, if you're too lazy to read the article, also I can point you, just watch the video. It's just a couple of minutes, but it's packed with information which I want to highlight here in my video. And really the article introduces the concept of critical months. And many investors know that equity markets are certainly very volatile. You may not know though the performance of an index or a mutual fund which holds many companies is often dependent on a very short period of performance history. And that's what they're highlighting in this article here. They've actually studied indices and larger funds in a 15-year periods where they say that, and they found that on average there were just 7.4 or 7.5 critical months in those 15-year durations where the gains or the highest impact of you being invested is attributed to just those 7.5 months. So say you invested in the S&P 500 for 15 years. If you missed those 7.5 critical months, that is, you got out because you thought, bottom is coming or the market is crashing, and then you try to get back in when there's seemingly a recovery, and you missed any of those 7.5 critical months, then you would have missed all the gains for the last 15 years. So here's my advice, guys, on whether you should be investing in the stock market now or in crypto or buy a house at the moment. Let me give you what is a good approach, in my opinion, considering the situation that we're facing. And firstly, I want to highlight that you have to remain in control during this pandemic and during this crisis that we're kind of embarking as we speak. There are a lot of unknowns at the moment, so what we can do is focus on the things that we can control rather than worry about the things we cannot control. And we can control three things ultimately in this crisis. We can control our emotions or attitude, we can control our outlook, and our actions. We can remain in control in the situation if we take and follow the right actions which are sound and not necessarily emotional, especially when it comes to investing. So number one action that I advise you to take is to save extra. Focus on increasing your emergency fund because you may lose your job. And I'm not trying to scare you. This is just, again, the reality. So you need to be able to recover and you need to be able to address the basics if you're to get fired. So housing, utilities, food, transportation, those are the four basic things that you need to have covered with your emergency fund. Secondly, if you have cash above and beyond that, those expenses that we just mentioned, then you can invest the money. Granted, you will not need the money in the next 5 years. And thirdly, you want to follow your investment plan. Your investment plan keeps you grounded. So the investment plan would have things like an investment philosophy to follow. Your asset allocation based on your risk tolerance is another important aspect of your investment plan. So how much stocks versus bond you should hold, how much cash, how much crypto or gold to stabilize the portfolio. Funds to hold, which funds you're going to be holding and in which accounts, in 401k, in a taxable or tax advantage accounts. These are all important considerations that you need to have in a way set in stone. And a few other considerations such as your kind of target allocation per fund and asset class. Lastly, don't chase the bottom. Don't time the market. Don't look for the ultimate bottom. Now is a good time to invest. Because chances are we have not hit the bottom yet. I'll be honest with you, probably the bottom is still coming. But we don't know when that will happen, so it's better to invest if you've got the extra cash. And that is my answer to you guys. Is now a good time to buy shares, Bitcoin, a house, gold? If you've got the extra cash, if that follows your investment plan, and if you've secured a big emergency fund, then absolutely it is a good time to buy. And don't run into safe havens, I think, gold or anything like that if it's not in your investment plan. If it is, then just follow it. Otherwise, don't make any rash decisions which you did not put in your investment statement as part of your plan. It's pretty simple, and I've always said it's simple to invest, but it's hard to execute because we're dealing with emotions, we're dealing with the panic that is surrounding us every now and then. So the execution is the hard part, but stay grounded, stay the course. Let me know what you think in the comments down below. Does this kind of strategy or do those actions resonate with you? By the way, we had a few new subscribers this week, and I just wanted to take a second here and thank you, each and every one of you. This really makes me feel that my efforts to spread the message and the knowledge about good investing practices is appreciated. If you made it this far in the video, don't forget to smash the like button As you know, this helps with YouTube so that more people can discover this video and this information. Subscribe if it's your first time here, and I'll see you in the next video. And until then, stay the course.